Good morning, ladies and gentlemen. We are slightly late with the video this week after a couple of days holiday, but situation really has not changed very much. We still have a period of low volatility. The spreads are still stuck firmly in negative territory, but slowly, as we can see from the graph, the situation is changing and we are ready to either break out to the upside and have a sustained bull market like we did throughout 2016 and 2017, or to continue down as we did back in the middle of 2015. I favor the latter, but probably for now we are in a period of lower volatility for the next several weeks, as we will now show you. To me, this chart is still very relevant. We are bumping up against the times 16 Blue Angel. I doubt very much that in this kind of environment we're going to escape from its pull, very much indeed. The times 16 comes up right here where we are, around the 27-25 area. I doubt we can go much higher than a couple of percentage points above it. That would take us somewhere close to 2800, but I just can't see it as A, sustainable, or B, that it can do it in a fast pace. To me, we are still stuck between the times 16 and the times 15. That will be the trading range, so basically somewhere around 2600 to 2750-ish, let's say. So we are much closer to the top than we are to the bottom, but every time we get this kind of behavior, volatility gets really hit, and we can have a look and see how that is panning out. The surprising thing is how low yields actually are given where we are in the stock market. It seems that stocks, just like in the latter part of last year, can only do well when yields are low, i.e. when the discounting factor is high. Every time yields back up, you get the stock market stopping its rally or even backing up with it. To me, that is an indication of a market which is not in risk on. It is a market which is basically pricing itself off volatility and yields. What are yields going to do here? Well, it looks like they are basically stuck between in the 5 years, between a 260 area and a 245 area. There is no reason for us to go outside of those parameters for the time being, simply because the incoming economic data is not bad enough to get us to go on the downside, and yet there is very little pressure on yields, which is not something that you would instinctively expect at this stage of the cycle. To me, this is ultimately bearish. The fact that we can stay in a 15 basis point trading range, which is so much lower than the trading range that we're in at in the latter part of last year. When you think about it, this is where we were in October. We were at 3% in October, and that is when the stock market started doing its swoon. Well, we should now, in theory, be well above this 280 area if we were just to mirror what stocks are doing, and we are not. And that is the canary in the coal mine to me. The fact that yields just cannot get higher indicates to me that the economy is far from having that strength which would put us into a sustained period of risk on. Much the same picture is evident in the 10-year. The 10-year now is basically stuck between a 278, 280, and let's call it 257. 20 basis point range, and that is all there is to it. what I've just said for the 5-year applies for the 10-year as well, and less so for the 30-year. The 30-year basically is trading in a range of, the TLT, call it 118, 119 to 122. Could it be doing an inverse head and shoulders? Absolutely. I'm not a great believer in those, but it just seems that there is so little pressure on yields that tells me that we are not in a period of risk, of changing from a risk off to a risk on, but that we are in a period of sideways consolidation before the market gets some economic data towards the end of towards the middle of the part of the year, when it will actually make up its mind which way it's going to go. We have so many unknowns at the moment, from trade policy to all kinds of other things, that we are likely to be going sideways as opposed to making a definitive statement about which way we want to go. Do we want to go into risk on or risk off? If we look at the yield differentials between the States and Germany, we're still in this 10 basis points trading range. Every time the Bund comes down, it actually emboldens people to buy 10-year notes. They use the euros to, they swap them out and they buy the higher yielding 10-year note. That is what is actually keeping the situation in the States anchored, and that is what is enabling people to actually bid up equities as a result. That seems to be the cycle. Europe is very weak. The ECB doesn't tighten in any way. In fact, it looks to help its banks by doing TLTRO operations. That leaks euros into the foreign exchange market. They get sold for dollars, and those dollars get used to buy a much higher yielding asset like the 10-year note or equities in the States. Very, very simple, and the transmission mechanism is the US dollar. And here we have the daily chart of the US dollar. If we zoom into it, we will see that we've had, almost 2 weeks of continuous strength as soon as it touched the 200-day moving average, which was at the famous level of 95.07. As soon as we touched it, straight back up. What does that tell me? That tells me that there is no pressure on the US dollar at the moment, and there is unlikely to be any pressure on the US dollar for quite some time. We are above 96.50. To me, the path of least resistance after a few sideways days is going to go and break the higher levels. If we change this format to a weekly, this is just, a very tight consolidation. If you have a look at this, we have the Bollinger Bands, which have come in so much. As soon as we start breaking up here above 97.59 or 97.54, I'm sorry, which is the close above there, I think we are off to the races. We're off to 99 and 100 without too much problem. This kind of tightening of the Bollinger Bands to me is an indicator of a bigger move, a more sustained move to come in the weeks ahead. I cannot be bearish of the dollar, just as I haven't been bearish of the dollar all year. Every time it gets to this 95.07, it's a real bounce up. To me, the risk is that we now break hard higher. Well, what does a break higher in the US dollar actually mean? It means that US equities are going to have a headwind. And here we have volatility, which has been a much better chart, hasn't it? Weekly volatility, 1, 2, 3, 4, 5, 6, 7 weeks down. 200-week moving average coming in at 1490, right about where we are now. Lower Bollinger Bands here are going to be somewhere around 13. To me, this is a market which is doing a wedge. It is going to spend more weeks here below 15, and then at some stage it's going to do another burst higher. This is a market which is which is telling me that equities are going to be in maybe a slightly upward sloping range. You know what I've been saying earlier, that we might get to somewhere near 2800, but it's telling me that this is a labored market. This is not a trending market. Every time it goes up 10-15 points in the S&Ps and people get long, we're going to have 20 points downdrafts, and then again it's a stair-stepping kind of market. It is the market where you want to have ratio put spreads, which is the only position I really have on. And you basically do not want to be long of volatility. You want to let lower volatility and time do the work for you. So another few weeks of lower volatility, I would have thought something around the 13 level, and then we will be ready to make a move higher. So probably another month of trading somewhere north of 2677. 2677 now has become a very, very important level in the S&Ps. On a daily basis of volatility, it'll be very clear when we no longer wish to be short of volatility. It'll be when we close above this middle Bollinger line. It has respected it very, very nicely. Any close above there, above 1760, we will know it's time to get out. But for the time being, we still have room to come all the way down to 14-ish in the next couple of days, and probably make new highs in the S&Ps. Probably no higher than 2750. But volatility here is definitely taking the strain and doing most of the work for the S&Ps. It is very obvious in the S&Ps how they are trading. They're really respecting previous levels. What was the previous level? 2777. Sorry, 2677. We just have not, once we broke up on the Fed statement, we have been completely unable to break below it. Every time we get within a couple of ticks, buyers appear and up we go. The 200-day moving average now to me is a done deal. At some stage we will trade this 2742, but we're so close to the top of the Bollinger Bands, this will actually flatten out. So somewhere in the 2750s is the absolute top we're going to get, and then we're going to have breaks back down. A mirror image of what volatility is telling us. Do not sell it around the 2700 level. There is no point. Much better to sell it below 77 than to sell 2700. Because 2700 has 50 points of risk on the upside. Once we break 2677, you'll have very little risk on the upside. Chances are it'll break hard, and it'll break hard all the way down to 2625-ish. From a weekly chart standpoint, I mean, it's quite obvious that we are losing impetus at these levels. We are basically supported by this red line. You don't want to sell anywhere near 2700 even. There is no point, and you want to basically get long somewhere close to it, and then go up towards the when we get up towards the 20. Here we are, those levels, 2775, 2750 to 2775 is going to be very, very toppy, and that is where you want to get out. It is always useful to have the transports as some kind of a lead, and here we are the transports yesterday actually made a higher high. To me, a test of the 10,550 level in the transports is a done deal. It is not very far, but there again, that is all you're looking for. You're looking for the market not going very far, and but the upside, probing of the upside, is definitely the favored side. If we go over to Europe and the daily DAX, you can see that all it's done is basically it's closing the Bollinger Bands, it's tested the lower band, filled the gap, straight back up. That also tells you that if a weak market like the DAX cannot do an impulsive move down, and it never looked impulsive really. I was looking at it very hard. I thought, shall I sell it? Shall I sell it? No, it's just not impulsive. It's probably a better buy than a sell. Here we are. I have, a long position in S&Ps against the Europeans. I just think that's the way to stay, as it were. To me, the DAX is very much a leader. It's basically all it's doing is now test the 11,500 level, wait for the 200-day moving average to come down, and in about a couple of months' time it'll be ready to break hard. That's the way I look at it. To me, that is a symmetry towards to what the S&Ps are doing. Slight breaks higher, no momentum, no volatility, and the market then comes back of its own gravity. This can be seen even better in the Nikkei. I mean, what a tight trading range. It's respecting the Bollinger Bands very well. It's respecting everything. So, a 500-point trading range in the Nikkei is almost nothing. And here we are. We're probably now going to break slightly higher and trade towards the 21,500 level. Wouldn't surprise at all. So they're just mirror images but squashed of the S&Ps. The fact that neither Japan nor Europe can make significant headway or even keep up with the S&Ps is fairly evident. Why? To me, it's a function of people buying the S&Ps through cheap dollars they're getting through other people's QE. So that is all there is to be said. A period of lower volatility where the upside in the equities is not huge, but the downside is almost non-existent, and a period in which technical trading dominates as opposed to trend trading. So what are the biases? Well, very few. The 5-year now is in a range between 240 and 260. That is all that can be said for it. I would not want to be long of 5 years at the moment. I think it's more likely to trade towards 260 than break 240. I prefer the upside in the bonds. Money is basically leaking out of Europe and Japan through their QE and supporting US assets. 2677, 2725 major league chop. Well, we've had it. We don't get the dips into 2650. That is now out of the question. What we are going to get now are moves more likely towards 2745, 2755. That to me seems to be almost guaranteed. But I really wouldn't get excited about prices up there and getting long up there. To me, this is some sort of a wedge, as I've shown you, with 2680 as the bottom and 2750, 60, 70 as the top. I still don't like NQ. It has no leadership. Apple has no leadership. Google has no leadership. Amazon has no leadership. To me, something else is happening here, and NQ, there is absolutely no point in trading it, apart from on the downside. VX, not bullish at all. As I said, 1650 we got there, 1608 we got there, but we bounced a little off those levels, but not very much. Now I would say there is no support till the low 14s. And this is going to take time to turn around. That's why I think we are more likely to test these levels up here in the S&Ps than the 2677 level anytime soon. European equities, as I said, the place to be short is 3200. Now it'll probably break slightly higher to 3250, and that is really where I want to take a major stab at shorting it. The little bit of shorts that I put on up there are fine. I cover them, big deal. But this is going to be that kind of a market, the big deal kind of a market. Things are now, you have to abandon the recency bias of the 100-point move in the S&Ps in an afternoon. Just not going to happen. Volatility is low and staying low and going lower, which basically means that if you can make 10 points in the S&Ps, that is a great trade. And actually, you just need to leverage up to achieve the profits that you were earlier in an afternoon. DX, to me, that 200-day moving average says everything. 95.07 as a level says everything, and 93.63 as a level says everything. We are now busting through the top side. Any kind of a 0.25% dip in DX, I am a buyer to position myself for those breaks that I showed you in the video, well above the 97 level and on our way to 100. Thank you very much indeed, and tweet you in a moment.